Welcome to the NFT Finance Podcast, sponsored by Goblin Sachs. My name is Terry, and I'll be your host today. Today, we welcome Snowsledge from Voyager, a research lab building smart contract wallets, and David from Metastreet, an interest rate protocol for the metaverse. We have a very, very special episode today. Astute listeners will know both guests have already been on this show. So if you actually want more context about, who they are, what their protocols does, please go check out our previous episodes. Won't be spending that much time on that. But yeah, Snowsledge, David, welcome on the show.
Thanks for the invite, Terry. Great to be on.
It's a pleasure.
Yeah, considering that you guys have already been on the podcast, would just love a quick, say, 30-second introduction of who you are, what your protocol does, and how it's related to NFT finance.
Right. We were previously working on Voyager protocol, which is a smart contract wallet that allows you to buy now, pay later for NFTs, and we supported OpenSea and LooksRare at launch. So that happened during November of last year, before the FTX incident, we launched and we tried that out, and with a few partners being involved. But at the end of the day, we decided to pivot away after we seeing that new entrants is not really coming into NFTs, and our thesis itself was kind of like invalidated at a point. So that's why, hence we pivot away from that, and now we're working on other stuff that's related to smart contract wallets.
Hey, that's David. Metastreet is building kind of like a debt scalability product around non-fungible assets, and PowerSweep is one of the few products that we created that builds off of that core liquidity engine. We built it on top of reservoirs, so you could buy certain covered collections that has debt liquidity to combine it with a flash loan to buy with that debt product, because it was a standing bid, so it's always available. You can also roll it over perpetually. It's been limited success across all buy now pay later platforms. People call it down payments or mortgages or stuff like that. I think it's because it is quite early with how it's structured and how it's perceived and how it's understood. So it's a product and market definitely there's a big distance between them. But I think there's ways to overcome a lot of those issues to find a product that becomes competitive with almost like a market trading product. Because at the end of the day, it's less so a buy now pay later concept, which is a very Silicon Valley hey, three payments later. It's more so like a risk product, where you're kind of structuring the edge cases of these durations and entries and exits rather than thinking about it as a short-term buy, or a product that you can use, which is kind of how a lot of people think about the firms of the world. Happy to give my thoughts on where this product could evolve into as a theory, and why it could be an interesting field in the future, but not today.
Gotcha. Yeah, would love to delve much, much more deeper into sort of everything that you said just now. But I guess we can start off Snowsledge, BNPL, whether that's this type of what David mentioned, this Affirm type of product that's more like a payments product, or more so something that's a risk product, something that's more related to a financial structure product. BNPL in general seems like there's a lot of people doing this, a lot of marketplaces doing this, a lot of NFT lending protocols that are diving into this field. Are we ready for it? Are we not ready for it? We would love to gain your perspective as to why you pivoted away from this.
Yeah, thanks, Terry. I definitely agree with David that it's not similar to Affirm, because the players that uses BNPL so far has not been new entrants to the NFT space, and we already seen the new entrants to the space being hindered because of all the bad news that you hear about crypto recently. So most of the products that's being used in the lending facilities wise are reverse mortgage, which is just a way for you to get credit from your existing NFT collection. And those guys are using it because they are mostly market makers, or they are using it to leverage themselves to farm more blur tokens. And I don't really see too much of a use case other than it being a leverage at this point of time. And we are mostly seeing flows in a more like a PvP environment. And that's kind of like the state of things, in my opinion. So BNPL as a way, probably it takes more of a retail flow to come in before it becomes validated as a thesis. And I think that will be in sync with what I guess the Polygon ecosystem is trying to do right now, trying to bring new entrants through Web2 brands. And that's where probably BNPL will shine as more like a firm kind of like product than the current situation where it's more PFP dominance in the collection space for the NFTs, and where it's more of like a leverage trading product for the traders itself.
Gotcha. David, I'm curious what you think about that. Especially, it seems like from your previous introduction, you regard Parasweep as more of a sophisticated product that's not a predominantly supposed to be used by retail, but rather by sophisticated NFT traders, NFT collectors. So yeah, like how would you respond to that?
I do agree with that sentiment, though, with regards to like the retail is just not ready for that kind of product. I think it can develop into it in the future. I think usually what really catches people's attentions are like positive carry trades. I might be financializing simple ideas, but like this is actually just my thesis around like NFT finance, just being a limited industry because it is a subsector of a subsector. And what I try to encourage is like, how do you think of NFT finance before you think of NFTs? Because a margin product like this is functionally an NFT finance product. Thing is, you only use that if you're familiar with this kind of product. I think there was like a metaphor of the can opener. You don't know what a can opener does unless you know what a can is. And this kind of situation here is like the only people that there is a significant amount of lending volume in the NFT finance space has been growing. So functionally, buying an asset with leverage is a captive use case of that leverage. So it should technically exist. It just maybe is probably user interfaces, the user experiences, and kind of the thinking around the market sizing and how they get introduced to this market is almost like a limiter. Because if people are doing reverse mortgages, then mortgages should theoretically have some fact over market. But people aren't really, I mean, even in interfaces for like BendDAO to our platform, like it's not really designed for like thinking about entries and exits, what profitability is, what's the function of these like purchases. Is it to gain a profit, or is it to buy an asset and pay it down? So I think that's a discovery phase right now for where these what this product is really tailored for, and the UX and UI for those kind of like user bases, whether it's professionals who are looking to do trades, or if it's retail trying to do like this positive carry trade. Where the example I'm giving here is like when you buy a house to do an Airbnb arbitrage. I think you can use that as like a comparable. Like you think about doing the arbitrage before you even buy the house. And that's what I'm trying to encourage. How can you do a trade before you own the stock? And when you're thinking like that, that's when I think it gets a lot more interesting. That's why I'm kind of excited about Liquid Delegate, because what if you could do like, you could borrow at a cheap rate and then rent it out at a higher rate? That's an arbitrage. And that's very popular globally for Airbnbs and people doing that all over. That's actually increased all like real estate strategies generally. That kind of thinking of the trade before the stock, or thinking of the trade before the NFT, I think is a point that we have not reached. Therefore, it's hard to get retail to understand this, again, positive carry kind of trade. And again, this is no different from investment banks like selling a sales desk, right? They're selling a trade. They're not selling a stock. That's my, I guess, long-term answer.
Gotcha. So it seems like it's like a two-pronged problem. Number one, there's a lack of awareness, within the NFT market and the NFT finance market that you can actually use these protocols. But number two, and perhaps more importantly, David, you alluded, it's that at the moment, the NFT markets are just fundamentally different and not suitable for BNPL, because it's not like it's a consumer good or something that you can use and something that you need right now. On the other hand, it's not like there are yield generation opportunities that then you can use for a positive carry trade if you were to do something with BNPL. Is that sort of the correct characterization, David?
Yeah, and you're kind of seeing that with the duration of loans kind of being exposed based on the platforms that is being originated too. Because if you look at like NFT Fi, they're doing like longer duration loan, 30 to and greater. Arcade's even longer than that for a lot of their collections because they're collector based borrowing. But X2Y2 and these marketplaces that are becoming more friendly to lending, X2Y2 has loans mostly originated from 3 to 14 days because it's getting closer and closer, and eventually you just make it 0 days, right? You just start with a loan, and why would you borrow against your Azuki to buy another Azuki? Just double down with a button, and that kind of thinking of like the market evolving, and this is a occurrence that happened in the last 3 to 4 months. That is happening in the market live, and I think it will mature to a point where the buy with leverage is going to be an interesting proposal to a lot of users who are the pro traders of the world in this age of blur.
Gotcha. That's very interesting. So the hypothesis is that on X2Y2, people are taking out these short-term loans to then speculate on the short-term price movement of the same NFT from the same collection, essentially.
Yeah. So I actually think it's almost like a debt structuring issue because you can only take leverage on things that are extremely like that are worth lending to. You can't borrow on like checks right now because it's so new. But if you create longer tail like lending structures where you can actually borrow against those assets and find that kind of market, then people can speculate instantaneously because people are borrowing against their Azuki because they can't borrow against a check, which is what they want to speculating on, or whatever new mint is coming out, like I don't know, Coinbase, blue chip or whatever. But because they can only leverage trade extremely high regarded like blue chips. Sorry, it's a bad example because I just said two things that are totally different. The Coinbase tokens or NFTs are things you can't get leverage on. So you have to borrow against an existing collection that has liquidity to get borrowing value to transfer it over to speculate on another asset. But that's just one example of the type of trades that exist today, and that is not conducive to a buy with leverage because you can't borrow to buy a very like speculative asset. It has to have history. So there's some mismatch in terms of the structure of the debt behind it.
Yeah, I agree. That's essentially kind of, I guess, one of the reasons why most of the reverse mortgage facilities have kind of like shined over the last few months. Also, it's because of blur bidding pool. It creates kind of like a very solid price floor where there's actually liquidity to liquidate into. So you as a lender, you don't have to be too much holding too much of an inventory risk, as opposed to in the past where you only have collection offers to take during the liquidation process. So there's not really good bidders that would want to execute the bid, even if, let's say, it's like 15% below the floor. You see that problem in BNPL previously during the whole cascading liquidation of apes. I think that was in like September of last year. I'm not sure what's the exact date. But you don't see this kind of situation right now. Even if, let's say, Machi were to just liquidate 100 apes at one time, you still have not much of a price movement even on the floor pricing. For I think that was like 1 week ago, which happened. So yeah, this kind of financial products itself, it will become much more popular as NFTs becomes more semi-fungible and you have more liquidity coming into the market. So definitely happy to see more kind of innovation in this kind of space. The current UX for BNPL and all the different kinds of P2P platforms like Arcade, X2Y2, and so on, NFT Fi as well. It's not that great because you have to like figure out all the different terms by yourself, and they have like different terminologies as well. So I think somewhere along the line, people would start to aggregate everything and become more like a Skyscanner kind of like facility. You can like figure out what are loan structures and discover and matchmake the lenders and the borrowers. That would be interesting experiment. And the interface that I guess that will be in the future will probably be like a cross-margin interface. So what Metastreet is doing, like power sweep, but instead of using ETH as the collateral to borrow money to sweep more stuff, they probably just use the apes that's existing in the inventory to create like more borrowing power for them to sweep even more stuff. So there's like just one step more to do, one step less to do as opposed to what they're doing right now. So that would be interesting, I think, as an interface for the different apes in future.
Just to clarify on our side, Metastreet actually doesn't have liquidations. We don't have an oracle. We actually do like fixed duration loans only. But I do see a market where you can have a floating. You can have effectively liquidation based lending be productive to that point. If you were to like divide the taxonomy of NFTs right now in the PFP world, there's like the blue chip collections, which I think Ben Dow has shown that even though I think their design is somewhat flawed. There's users that are still using that kind of like 60% LTV, and there's a liquidation point that has like some level of function to like leverage to speculate on interesting markets. I think buy now pay later / margin trading would be interesting once there's like a reason to borrow with leverage that would justify the cost. And right now, like there's not really, because speculating on boarded yachts with leverage, it's not really an interesting market yet because the movement's quite low. Whereas the movements on like longer tail assets, you can't even do a buy now pay later with liquidation based systems because, well, who's willing to do that? I think even blurs don't have bids on those kind of like edge markets. But if you can create lending markets for those kind of like long tails, then suddenly a buy now pay later product could be interesting because now you don't need to collateralize your existing collection to buy something with leverage at a structural level. But this is more so on the product structuring rather than the product design level. Is my thinking. But just want to clarify that we don't. Metastreet actually doesn't have liquidations on our side, like Bendao or the other platforms do, like JPEG.
Gotcha. Yeah, I mean, if I try to distill sort of the change there, it seems to me that, well, the prerequisites for BNPL to take off is number one, the carry trade opportunity, as in like there is something to do once you buy the NFT, but also that, and correct me if I'm wrong here, that when we have better, liquidity in the spot rate, then we can actually allow more people, or at least more lenders, to participate in the market. Or at least that was my takeaway from Snowsledge, your argument that like the Blur bidding pool has decreased inventory risk for lenders. Is that sort of a characterization?
Yes, it definitely did. So as a lender, the risk that you're taking is so much lower as opposed to like in September, before September. And now it's just pretty, at this point of time, if you are a ETH holder, you probably don't want to hold on to STETH. You probably just lend through Bendao or any kind of NFT products because you can get 20% yield, and liquidations itself doesn't really happen too often anymore. So I think that's kind of like a pretty good yield farming platform for all the different ETH whales out there with reasonable amount of risk at this point in time. So yeah.
Gotcha. Well, then, David, I'd want to ask you that, like, what types of carry trades can we enable, and how far are we away from these kind of being sort of common in the market, such that BNPL will take off?
Well, you can borrow underneath the U.S. Treasuries rate and put it in there if you wanted. That's one trade you could do. That's kind of what we're focusing on too. Is like, how do you find higher forms of yield in like the existing loan structuring market right now? Because obviously, going on a peer-to-peer lending platform actually yields higher rates, but it's difficult to win as a trade-off. Peer-to-pool also has like pretty high rates, but not as high as P2P. But those are usually subsidized significantly, right? It's an interesting trade-off. And a lot of the market is subsidized. I think Blur has done an amazing job kind of getting the initial market. Let's see like how whatever curve mechanism they do for like increasing market making incentives lasts for like other collections. But that still incentivizes the higher base collections, not so much the long tail. And right now, a lot of people are kind of bidding for exactly the issuance, which I think at this point is not even considered like a ephemeral. It's now like almost like a permanent concept because until there's some weird spiral where it's not economically worth market making anymore. But there's going to be bid liquidity going forward for certain collections. But the use of borrowed funds right now is to either clip a profit or is to like speculate on a long tail to also try to get a profit. And I think in those two paths of forward interest, positive carry trades could be possible if there is more if there is like yields that are getting more and more interesting. We're working on that to get like the triple digit yields that people have been dreaming about. But if that is possible, then there can be these like pseudo positive carry trades, which carries its own risk. But those scenarios have kind of died off with like DeFi kind of slowing down too. So, decently common trade that actually are like one of our big users was actually doing the Terra arbitrage, where they would borrow punks at like 10% and lend at 20% for on Terra until obviously Terra he got out, so he's good. But that was like a free money trade, right? Not free. It was very risky, but that kind of thing is exactly what the Airbnb arbitrage people kind of think like. It's also kind of why BlockFi and Grayscale happened too, right? So it could create like the same kind of like misunderstandings, but at the same time, that's usually those kind of like pseudo fixed products is what makes like positive carry, I guess, can be in other forms where it could be like you could be like selling vol or long vol or other kind of concepts. But the NFT user is so primitive right now. This really reminds me of exchanges in 2018, right? Like it was Binance Spot, and that was it. It was Poloniex, Bittrex, and these other guys. Then perps took like everything because of BitMEX, and then everybody started doing perps, and futures became more interesting than the spot market. And then now the perps control the future pricing of assets, and that took years to develop. And I think NFTs will just face the same kind of future, and maybe something a little more different because the assets are fundamentally different too. But I think we will get more advanced strategies. I think Blur's kind of growth kind of shows that advanced players are here to stay.
Yeah, that definitely I agree. It's a very spot market right now, and the types of derivative that probably would develop for NFTs will be very different from fungible. It's more like, as you say, housing markets. So probably going to see CDOs, swaps, all these kind of things going to pop up eventually over time. I think that's what you guys are doing. That's definitely the right direction compared to NFT perps.
Totally. I like to say the U.S. housing market, 1930s, they started, the first mortgages were 50% LTVs, and the insurance companies tried to fuck you all the time. I'm sorry if I'm on a podcast, but try to screw you every time. But that eventually got fixed with like insurance and consumer protections, and like you didn't get liquidated. There was like other processes, and then they had a 100-year bull market. Now it's worth $42 trillion. And obviously you can dream, but I think NFTs are headed the same direction because there are 50% LTVs right now today. And then like, how do you structure this to be more interesting? Because these are the founding building blocks of, the metaverse. Here I go visioning again.
I guess the only thing that I've found to date where you can get native yield on your NFT without routing through a borrowing pool or P2P, it was selling options, right? Essentially, David, you were saying long, short, vol. Of course, the counterparty isn't there to buy it, but like that could be, if we were to see a market where people are interested in speculating on like NFT options, like that could be something that would induce that carry trade, potentially.
Yeah. Well, what we're doing in our next product, it's like we have these. Our first product was really like two initial like junior and senior tranche, and now our next product has like multiple tranches, like that's infinitely scalable. So you could possibly borrow a lower rate and put it in like a higher belief because you don't think the floor would go down. So that's another game to play, and and then you have leverage on the lower tranches. So it's essentially stacking. So that's one form of yield we're trying to introduce in terms of a collaborative lending.
Snowsledge, David, to end it off, what is in store for the future of NFT finance? What do you think we'll see in the next 6 months?
I think probably you'll see more aggregators come out and people competing in the space where they just do vaults that do different tranching, and eventually, I guess swaps as well. So just these 3 different products, I think: aggregator interface, vaults with tranching, and then swaps. That's where innovation was probably continue down the route. And eventually, I think BNPL will come back, but that would take a long time, probably 2 years, 3 years. And at the point of time, then it will be fairly similar in terms of risk profile of like a retail getting mortgage in the housing market. That will be the point of time that will be very interesting for most people, because they can just offload their risks directly after they sold the bond to the retail. So that will be interesting. My point of view.
I think LTVs will continue to increase. I think the largest market right now is obviously NFT lending. It's the largest market, and in that specific sector, I think LTVs will go higher and higher. And the higher it goes, and the lower the rate is, it's a better substitute to actually selling. Much like when you own a house, you don't actually sell the house; you actually get a reverse mortgage to get cash. That's how people think. They don't want to lose it. It's part of their identity. It's like owning a car or equipment or anything like that. So as LTVs increase, I think it becomes a bigger substitute to actually trading it or selling it. Because it's your own. And I think as a result, I think lending will actually become a bigger market than spot trading in terms of volume. I think you're already seeing that for certain collections, but in terms of the blue chips, I think people borrow way more in terms of collateral value at risk than they actually trade it. In terms of origination numbers versus trading numbers, that's better compare apples to apples. So I think that's what's going to happen, and you'll see a lot more interesting products being built on top of that kind of basis. Because I think the spot market, like a market making game, is kind of a dead end, in my opinion. I think there's not that much things that can come out on the product side that's interesting. Just more microstructures. I think mobile will get really big too. I think actually kind of show the world that mobile is here to stay. And you have So Rare and Reddit collectibles. So I think that's another like edge market that's going to get interesting. And last thing I say about just general NFTs, I think that we're going to have an over-indexing issue where there's going to be so many NFTs. Like I play Tarkov, for example, and there's so many items in that game. And there's market makers in that game too, if you didn't know. But like it gets to the point where you can't even index with a single platform. So Reservoir is really interesting because you can scale infinitely with your own marketplaces. But also like when it comes to underwriting, comes to swaps, like can you scale with the same scale as a library, right? And unless you have a Dewey Decimal System, like it's going to get very, very difficult. So I think we'll have an over-indexing issue where you can't even count the NFTs and its variations and derivatives as gaming gets bigger and bigger. That's my predictions and the problems that we'll have to face.
Awesome. Snowsledge, David, thank you guys for your time.
Thank you. Thanks, Harry. Thanks, David.
Follow me on Twitter. I'm 0xTayTayHoHo on Twitter. That's Tay with an E. And you can follow Ryan at _Helmas.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.